Hi, welcome to a quick podcast I've put together where we're going to be looking at provision for bad and doubtful debts. It links to the topic that you should be studying of bad debts. First of all, a little bit of theory about why we do it. Well, ordinarily, so far in your accounting, what you've done is you've recorded the trade receivables exactly as they come off both the sales ledger control account or total trade receivables account, and therefore it equals the total of all the amounts owed by all of the credit customers. However, there's a problem here. In this $12,000 in this case of trade receivables, there are going to be some customers who don't pay them. Every business that sells on credit expects to experience some bad debts. And that's got to give us a problem because the previous concept says profits and assets shouldn't be overstated, losses and liabilities understated. Well, here, this asset of $12,000 is clearly overstated because some of those customers are going to be declared bankrupt and not payers. And it also links to the matching concept because expenses and revenues should be matched in the same time period. Well, we're going to have an expense of some of these customers not paying us, and there's nothing at the moment in the accounts to allow for that fact. So what we need to create is something called provision for bad and doubtful debts. And it's very much like a provision for depreciation. And provisions come from, for those of you studying A-level, IAS 37, which looks at something called provisions, contingent liabilities and contingent assets. And all provision is a liability of uncertain timing or amount. So in this case, we don't know exactly when some of these customers aren't going to pay us, and we don't know the exact amount of customers and the exact value of those customers that aren't going to pay us, but we need to account for, we need to make a best guess. And businesses can do that because they can use their past records. So it might be that normally they experience 5% of bad debts, for example. So the first thing we always need to do is to calculate how much provision needs to be in the account. It's very, very simple because you'll be given the amount of trade receivables, and what you'll also be given is a percentage rate. And that percentage rate normally stays at the same level, but might increase, for example, if we're going into a recession. So calculating the provision that's required at the year end, really easy. You know your trade receivables, you know your percentage rate, so you would just do 12,000 divided by 100 and multiply by 5. So the provision that this company needs to have at the end of the year is going to be $600. Accounting for it, well, it's a bit like depreciation, it's going to go straight into the income statement. So the expense, because there wasn't a provision at the end of the year, is going to be the full $600. That will be a debit entry or an expense in the income statement, and therefore we credit the provision for bad and doubtful debts. And it's a credit there because effectively what we've done, we've taken some of the profit that should belong to the owners as capital, and we've transferred that into our provision account. So it goes on the same side as it would do if it was given to the owners as part of their profit. And because this is a simple year with no opening balance, we've got a balance carry forward of $600, balance brought forward of $600, and that will be the account until next year. So quite simple. So what I want you to do is a quick first exercise. You've got some year-end trade receivables, and you just need to calculate what the year-end provisions are. It shouldn't take you very long, and then if you click pause and then jump back to the video when you've done those. Okay, welcome back. Now, for what companies actually experience, it's slightly more complicated because they will have some provision put on one side. And what you need to be clear about here is that that provision is never used for actually writing off bad debts. During the course of the years that bad debts happen, they will be written off exactly as I've shown you in the previous video, and those of you that I teach will have done in lesson time. So the bad debts in the year become an expense in the year. It doesn't touch the provision for bad debts. So for this example here, for this company, they started the year with a provision of $700. And if you remember, that's going to be on the credit side as a balance brought forward because it's really owner's capital that's being reduced and transferred to the provision account. The next thing that we need to do is to calculate how much provision we need at the end of the year. So pretty straightforward. You've got 18,000 divided by 100 times by 4 should come to 720. If you remember what we did when we didn't have an opening balance, okay, the balance carried down went on the debit side because the balance brought down has got to be on the credit side. So we'll put in the year-end provision. So balance carried down. And now we've got a bit of a problem because the debit side in this case is bigger than the credit side. So because it's bigger than the credit side, the extra amount will appear in the income statement because it is an expense, because we need to put a credit entry into the provision for doubtful debt account, and that's for the difference between the two. So we've increased the provision, we need to put in an additional expense, and the way that's going to appear in the income statement is we're going to get an expense of $20, and we're going to use the balance carried forward to reduce the trade receivables. So we do trade receivables less provision for doubtful debts, and that gives us a real figure for our trade receivables that we'll then use as part of our current assets of 17,280. Okay. Clearly, if bad debts increase and it becomes an expense, there is another possible scenario. So here, if we're looking at the following year for this business, what happens is their trade receivables now have actually decreased effectively in the second year that we are looking at. So we've got the balance brought down of 720 from the previous year, but this time the trade receivables are now only $16,000. So because the trade receivables are $16,000, at the end of the year, we only need $640 of provision. So the amount that will appear as a balance carried down will be $640. Okay, this time the credit side is bigger, so the totals are going to be $720. And therefore, what we're going to need to do is we're going to need to put a debit entry in this time in the provision account of $80, and that's going to appear as a credit entry in the income statement. So because it's a credit entry, it's going to be treated as an additional income. So if we have a look at what we're going to now do with this $80 in the income statement, we're going to add it on to gross profit as an additional income. Okay, and the trade receivables, well, they're going to reduce from $16,000 by $640, so the total is going to be $15,360. Okay. Right, so you guys have got a worksheet now to work through. You're going to do 2 years for the same business, exactly as I've done. Okay, so what I want you to do is to do the first year where the provision increases. When the provision increases, it becomes an expense in the income statement. And for the second year, don't forget to put your balance brought forward, and I'll put a link so it will automatically come from one of the boxes in your spreadsheet and show what you would do if we actually have to decrease the amount of provision. Good luck with that. Don't forget to email it across to me. Don't forget to fill in the box. Tell me what you do and don't understand. We're doing a bit more work, probably on some more complicated questions in the lesson. So I'm looking forward to seeing some excellent answers. Thanks a lot. Bye-bye.